Hello guys, welcome back to another exciting video. In this video we are going to establish an understanding about the basics of the balance sheet. So on the start, what is a balance sheet? A balance sheet is one of the key financial statements that gives the snapshot of a company's financial position. It is the representation of the accounting equation that states that assets are equal to liabilities plus equity. The balance sheet provides a clear picture of company's financial stability and liquidity. It helps the management to make the informed decisions about the capital investments, debt management, and other operational strategies. There are three key financial statements for any business, and that are the balance sheet, the income statement, and the cash flow statement. The balance sheet provides details about the assets, liabilities, and equity. I will explain each of these three in the later section. The income statement provides details of the income and the expenses for a period of time. And the cash flow provides the cash inflows and outflows of the business. On the basis of these three financial statements, the business can make reliable decision making. Now let's define three key components of the balance sheet, that are assets, liabilities, and equity. Let's start with the assets. Assets are the economic resources that are owned by a business. They are primarily classified into two types, that are current assets and the non-current assets. Current assets are expected to be utilized within 12 months. They are also known as short-lived assets. Some of the common examples of current assets are cash, inventory, bank, and accounts receivable. On the second comes the non-current assets. These are the long-term assets and that are expected to be utilized for 12 months or even more. The common examples of the non-current assets are property, plant, and equipment, and vehicles. The second key component of the balance sheet is liability. Liability simply means the obligations that a business needs to pay to its vendors. Just like assets, they are also classified into two types, current liabilities and the non-current liabilities. Current liabilities are short-term obligations that are expected to be settled within 12 months. The common examples of current liabilities are accounts payable, taxes, and accrued expenses. Accrued expenses like the expenses that a business has incurred but they are yet to be paid. For example, rent. If a business takes a building on a rent and pays the rent after 1 month, so the business has incurred the expense but it is not paid yet, and it will be payable after like 1 month. So this is a common example of accrued expenses. On the second comes the non-current liabilities. They are the long-term obligations that a business can settle after 12 months. They can last for like years. Common examples of the non-current liabilities are loan and long-term lease obligations. The third key element of the balance sheet is equity. Equity means the owner's share in the business. The common form of equity is the owner's capital, which is also known as the share capital, and the retained earnings. The retained earnings are the accumulated profits and losses that a business has incurred during the past periods, and they kept showing on the balance sheet under the share capital. A balance sheet is prepared from a trial balance. The trial balance is just like the snapshot of chart of accounts. Every expense, every income, every liability or assets or the equity that a business has appears on the trial balance, and the trial balance is prepared from the T accounts, just like this, the cash. Now you can see on the top it says brought forward or brought down 1000. Now this brought down means that this is the 1000 that is the ending cash balance for the previous year of the business. For example, let's assume that the last year was 2022. So this brought down balance was actually the closing balance of the year 2022. Now on 1st of January 2023, this balance will appear as the opening balance or the brought down balance that is brought forward from the previous year. and the receipts are the cash inflows in the business, and the payments are the cash outflows from the business. On the bottom, there is closing down balance of cash, and this is the closing balance of the cash for the year 2023. And now comes the trial balance. You can see starting from the cash till the retained earnings, these are all the balance sheet accounts. And on the bottom, from sales to selling expense, all of these are the income statement accounts. And the trial balance gives a summarized view of all the accounts for the transactions that have been incurring in those accounts. And all of these amounts are extracted from the ledger balances. Just like I have shown you the cash ledger, the same way a ledger is created for each of these accounts, and their closing balance appears here on the trial balance, except for the income statement items or the accounts. For the income statement accounts, there is no opening or closing balance. Whatever the transactions incurred for the year are closed. Like if there are sales for 27,000, now this is not going to be a brought down balance for the next year. This account is closed. All the income and expenses are closed down, and their ending balance appears on the trial balance. And on the next year, it is again going to start from zero. Another important aspect is that the retained earnings shown on the trial balance are opening retained earnings. Like on the trial balance, you can see there are retained earnings of 3,000. So these are the retained earnings that are brought forward from the previous year. In this year, what is going to happen is that this retained earnings opening balance is going to be added in the profit for this year, and then it will form the closing retained earnings, which will be carried forward to the balance sheet. Now let's try to calculate the profit of this year. As you can see, the sales are 27,000. I'm assuming the opening and closing inventory are the same. So it is like 2,000 is the opening and 2,000 is the closing. And then comes the purchases. And we will add the opening inventory, add the purchases, and deduct the closing inventory. And this will bring us to our cost of goods sold. And after deducting the cost of goods sold from sales, gross profit is calculated, and from the gross profit we will deduct the admin expenses and the selling expenses. This will bring us to the net profit for the year, and this net profit will be added to the opening retained earnings. So the opening retained earnings are 3,000, the profit for this year is 7,300, and then it will form the closing retained earning balance of 10,300. Now this is the balance of the retained earning that will appear on the balance sheet for the current year, and this is the balance sheet that is prepared from the trial balance. And this is the standard view of the balance sheet, where the assets are on the left hand side and they are classified into current assets and the non-current assets, and on the right hand side comes the liabilities and equity, and the liabilities are also classified into current liabilities and the non-current liabilities. And then finally comes the capital stock or share capital and the retained earnings. And you can see here the balance of the retained earnings are 10,300, and this retained earning will become the opening retained earning of the next year, and then the profit will be added for that year, and that will become the final retained earning balance for the next year. So this is a little tricky, or you can say the technical aspect of the retained earnings in the balance sheet. The other balances are extracted from the trial balance, and this is how the balance sheet is created. Now there can be other types of assets and liabilities as well. For example, there can be intangible assets like goodwill, a software, a license, or a copyright that also appear on the asset side. But to keep things simple, this is the basic, standard, and classic view of the balance sheet you are going to see for most of the companies. Now the sub-accounts of the assets and liabilities may vary, but the ultimate shape of the balance sheet is this. And this concludes our today's video, that what is a balance sheet, how it is formed. I hope you liked the video, and see you next time with more interesting videos. Thank you for watching.